You're tuned in to Tax Talk DC with the Office of Tax and Revenue. Join us as we offer insights on the city's tax initiatives, share important resources for residents, and get answers to some of your most pressing tax questions. Now, here's your host, Jennifer Valentine.
This episode was recorded September 2025. Some content shared here may no longer be applicable. Please visit mytax.dc.gov for more information.
Hello, and welcome to Tax Talk DC, where we break down the tax topics that matter most to you. I'm your host, Jennifer Valentine, and we've got another great episode lined up for you today. Joining me for this episode is Paul Smith, taxpayer advocate for the District of Columbia. Paul and I will be discussing OTR's Office of the Taxpayer Advocate, also known as OTA, the role of the taxpayer advocate in protecting taxpayer rights, and we'll review recent legislative changes that may impact you as a taxpayer. Also, we are thrilled to have a very special guest joining Paul for today's Tax Talk, Ms. Nina Olson, the current Executive Director of the Center for Taxpayer Rights and former National Taxpayer Advocate. We're so excited to explore these topics with our esteemed guests. So let's get into it, DC. Hi, Nina and Paul. Welcome to the podcast. Thank you both so much for joining us today.
Hi, Jennifer. Thank you for having us.
Hi,
yeah,
Nina.
thank you for having us.
Thank you, Nina. Now, before we get into our discussion topics, let's chat a bit about your backgrounds and your current roles in taxpayer advocacy. Paul, let's start with you. Can you talk about your past experience and share a brief overview of OTA and the tasks you undertake in your current role as taxpayer advocate for the district?
Sure, absolutely. So I've been the taxpayer advocate for almost 3 years now. In January, actually, will be my three-year anniversary. So it's been an exciting almost 3 years as a taxpayer advocate with the Office of Tax and Revenue. Prior to being the taxpayer advocate, I was the director and supervising attorney at a low-income taxpayer clinic at the Catholic University of America's Columbus School of Law, where we provided direct representation for taxpayers who are having controversies with the IRS.
Okay.
I was at CUA for about 14 years. And then way before then, I was actually in public education.
Oh, wow.
I started out as a classroom teacher teaching 8th grade science and, left as a building administrator. So I have a wide variety of background of experiences.
Yes. Well, congratulations on your 3-year anniversary.
Thank you.
And thank you for sharing that background. Now, Nina, can you also share a bit about your background and help us understand the roles of both the National Taxpayer Advocate and the Center for Taxpayer Rights?
Sure. Well, first of all, this is my 50th year messing around in tax and tax administration and taxpayer rights. So I feel like I've reached some kind of milestone there. I started
Absolutely.
I started out as an unenrolled return preparer and early on saw the problems that low-income taxpayers had. So founded the first low-income taxpayer clinic in the country that wasn't affiliated with a law or accounting school. It was freestanding nonprofit. And from that, I was selected to be the National Taxpayer Advocate of the IRS. It's a large organization even now that helps taxpayers solve their problems with the IRS. Congress created it in order to make sure that taxpayers had a voice inside the IRS and that their rights were protected. And I served in that position for 18 years, stepped down in the summer of 2019 and immediately founded the Center for Taxpayer Rights, which was really just continuing my lifelong work of trying to educate taxpayers about their rights before tax agencies, the role taxation plays in improving the social welfare of all, and particularly advocating for the rights of low-income and unrepresented taxpayers. So we do have a low-income taxpayer clinic where we represent taxpayers, but we also work around the world internationally and domestically, and we're nationwide.
Wow, that's excellent. Thank you so much, Nina, for sharing your background and that very important information about taxpayers' rights and their resources. We're going to talk a little bit more about the clinic and the foundation later, but next I'd like to discuss a burning topic on which I'm sure our listeners are interested in receiving both your expertise, and that is the impact of the One Big Beautiful Bill Act. So the OBBBA was signed into law on July 4th and has a significant effect on federal taxes, credits, and deductions. So let's talk a little bit about the parts of the Act that may affect the average taxpayer, specifically the new deductions that will have the broadest impact. This time, Nina, I think I'll start with you. If you wouldn't mind, talk to us about the no tax on tips deduction. Maybe share when it's effective, who's eligible, what tips qualify, any limitations, and, any general filing requirements to be able to receive the deduction.
Yeah, this is a major provision. And although it sounds like it's very easy, when you get into the details, it's not easy to apply.
Okay.
We are lucky in that the IRS and Treasury have issued some proposed regulations. So of all the provisions, we do have some sense of where they're going, and it shows the complexity. The simple thing is, or the first warning I have to say, is that this deduction, this no tax on tips, only applies to income taxes. So you're still going to have your Social Security, it's still that those tip income is still going to be subject to Social Security tax. And it's not clear whether you get to deduct it in order to figure your calculations for other credits. It sounds like you can't. It's going to, it's not going to change your income for other credit purposes. So for single individuals, people filing singly, it's up to the deduction is up to $25,000 per individual. And it starts to phase out, get lessen when your income is at $150,000. For married filing joint, the deduction can be up to $50,000, and it will be phasing out at $300,000, what they call modified adjusted gross income. But the trick is that it's $25,000 per worker. It's not like if you have one worker and they have $50,000 of tip because they're married filing joint, they can deduct $50,000. It's $25,000 for each. Workers have to have a Social Security number. There is no deduction if you're filing separately, and it's available whether you're claiming standard deduction or itemized deductions. Now, this is where the complexity comes in. Treasury has just released a list of occupations that are basically considered to have, quote unquote, customarily or regularly received tips as of basically today.
Okay.
And that list, it's long, it's like 4 or 5 pages long, but employers are going to have to put on your W-2 a code that says that you are in one of those occupations. And if your W-2 doesn't have it, then it's very likely that if you try to take that deduction, the IRS is going to, adjust your return accordingly. The other thing is, and this is where the trickiness comes in, and I do want to spend a little bit of time going through these examples.
Okay.
The tip must be voluntary and without compulsion. That's the definition of a tip, a payment that's voluntary and without compulsion. And that makes it a qualified tip. And so the regs give some issues. So let's give some examples that people will really face. And this impacts the workers as well as those of us that are just trying to advise people. One of the issues, the examples in the regulation are if there's an automatic service charge on the bill, like they're just automatically adding 18%,
right.
That's not a qualified tip because it's not voluntary. They've added it. But if you add on, for example, another 3% tip, that 3% part is a qualified tip. Now, how people are going to do, accounting for that, who knows?
Right.
Another example of a point of sale device, which you see a lot, that the server's coming to the table and they just take they take your credit card and you get this little thing on the screen that says, you can do 15%, 18%, 20%, other, no tip at all. And the regs say, well, if they've got the option of no tip, then whatever tip you choose, it becomes voluntary because you had the option of no tip. And so that is a qualified tip. But if it doesn't have the option for no tip, then it's not, if you pick 15, 18, or 20, it doesn't matter. That's not a voluntary tip. You had no option. So they're going to have to be some software people doing some programming in order to make sure everything has no tips. Another thing to note is that pooled tips qualify. And what that does is it opens this deduction to people, not necessarily in the front of the house, for example, in a restaurant, the servers having the interaction with the customers, but the dishwashers, because if they pool tips, then the dishwasher gets some share of the tips. And the regs say those people will qualify for a tip deduction. So one thing is there's going to be, like I said, a new box on the W-2 for an occupation code. There will be a new schedule on the 1040 1-A to report and justify all this. And there are some complications when you get to the state level because, and we can talk about that later, but some states are decoupling from this provision. So you'll have some things that you may have to add back at your state tax return.
Understood. Thank you so much. That's some very valuable information for our listeners. Now, can you provide a similar summary on the no tax on overtime deduction?
Yeah, and this I have to be a lot shorter because we don't have a regulation yet about, or a proposed regulation about how they're going to do this. And I should also say that this no tax on tips and no tax on overtime only applies to tax years 2025 to 2028. So, Congress is going to have to do something for tax year 2029 or else these provisions disappear. So for no tax on overtime, you can deduct up to $12,500 if you're single of overtime, or $25,000 of qualified overtime compensation if you're married filing joint. And again, married filing separately isn't eligible. And again, you need a Social Security number, and it doesn't matter if you itemize or you take the standard deduction. And similar to the no tax on tip, there phase out of the benefit at $150,000 of AGI for single and $300,000 for married filing joint. Now, here's the catch. If you're paid time and a half, the deduction only applies to the half. Because the time is your regular wage. And so if you're paid 150% for your overtime work, the deduction only counts to 50% of, that 50%. They also said that tips earned during overtime don't count because you can't double dip. You can claim those tips under the tip deduction, but you can't claim it for overtime. So what workers qualify? Well, they rely on the Federal Fair Labor Standard Act, so it's mainly hourly, non-salaried employees. Overtime wages have to be paid at a higher rate than regular wages because otherwise your regular wages don't qualify. You need to have that SSN. And it's not clear whether self-employed workers qualify. Like, how do you account for overtime if you're self-employed, you're working all the time. So we're waiting on guidance for that. The employers have to report the overtime wages on the W-2, but here's the catch. The IRS isn't going to have a dedicated box for the 2025 W-2. So it might show up in some other box on the W-2, like box 14, or it might show up in a separate statement from the employer. And if it comes in a separate statement, people really need to save that statement in case they claim this deduction and then they're audited. And they also said that in 2025 employers, because as you noted, that the act didn't pass until July 4th, right, that employers can use the second half of the year overtime figures to basically average out the whole year's amount of overtime for 2025, So, that's now again, overtime hours are still subject to payroll taxes, Social Security, Medicare, et cetera. So it's just an income tax deduction. And we'll have to wait to see what more guidance they get out. And we always have the issue of the state-federal mismatch.
Right. Okay. Thank you for that. I think that was pretty clear based on the information you have available right now. Now, Paul, we're going to switch over to you. Our next deduction we want to discuss is the additional deduction for seniors. Can you please walk us through how this deduction will work and who's eligible?
Sure, absolutely. Just as Nina mentioned, this deduction is also only effective for tax years 2025 through 2028. So again, for this deduction to carry over to 2029, as mentioned, Congress would actually have to extend this deduction as well. So the increased deduction for seniors are for taxpayers who are age 65 or older, but the last day of the tax year in which they're trying to claim the deduction. So in other words, you'd have to be 65 by December 31st of 2025 in order to use that deduction for tax year 2025. The deduction itself is actually an additional $6,000 deduction for seniors, or $12,000 if married filing jointly, if both spouses qualify.
Right.
This new deduction is an addition, and I want to emphasize this, that this is actually an addition to the current additional standard deduction for seniors. So what does that mean when I say all that? There's like these bonuses and all this kind of stuff. So for a senior in tax year 2025, so let's just say that they're an eligible single taxpayer who's 65 or older by the end of the year, they would potentially receive a deduction of around $23,750. Now, how do I get to that figure? So first, the base standard deduction for tax year 2025 is $15,750. So everybody gets that if you're taking standard deduction, right? Mm-hmm. All seniors 65 and older, they get the age-based extra deduction of $2,000. That's something that's been around for a while. Mm-hmm. And then the new bonus deduction is on top of those two figures. Again, the $6,000. If you add all that up, you'll get a total deduction of $23,750. So that could have an impact, a big impact on your bottom line tax liability. The other thing that's, I think, important to point out with this is for taxpayers who actually itemize their deductions. So if you itemize the $6,000, you are able to actually add the $6,000 bonus deduction on top of all of your itemized deductions. So you don't lose it if you itemize. Some deductions you lose if you itemize. So this is important.
Yeah.
Just as Nina mentioned before, on the other deductions, there are phase-out income limits. And so the deduction does start to phase out for taxpayers who have a modified adjusted gross income of over $75,000 or $150,000 if they are joint filers.
Okay.
The other thing is that if the taxpayers are married, they must file married filing jointly. So if two seniors who qualify, married filing separately, the $6,000 bonus deduction, you do not qualify for that.
Understood. Okay. One last deduction we want to talk about. The no tax on car loan interest deduction. Can you share the pertinent details for this possible savings opportunity?
Sure. So again, similar to the other deductions, this deduction is only effective through 2025 through 28. And this deduction allows individuals to deduct interest that's paid on a loan used to purchase a qualified vehicle, provided that the vehicle is purchased for personal use. If you lease the vehicle, it does not count. So it actually has to be a purchase, and again, for personal use. The maximum annual deduction is $10,000. So it just depends upon how much, but it caps at $10,000. Okay. The other thing is that, of course, this deduction also phases out, just like all the other ones. And so here, if you're single, it starts to phase out at $100,000. And for joint filers, it starts to phase out at $200,000. Also, I just want to point out to qualify, the interest must be paid on a loan that is originated after December 31st, 2024. So starting January 1, 2025. The loan must have been used to purchase a vehicle that is used by the taxpayer, again, for personal use.
Right.
Now, this is where this can sometimes become complicated, right? Because a lot of Uber drivers, Lyft drivers, folks within the gig economy, they use their personal vehicle to drive.
Right.
So what does that mean?
Right.
So, and because you can deduct the miles that you drive under Uber as a business expense. So does that mean that you can deduct also that portion of the interest, if you will, for this deduction? And the answer is no.
Okay.
So you actually have to be able to tease that out almost. Mm-hmm. So let's say, for example, you drive your car 60% for personal use, 40% for business, Uber, Lyft, or whatever the case may be. You can only take then 60% of the allowable deduction for your personal taxes.
Understood.
Right. So you got to make sure that you're separating those out.
Right.
Yeah.
Similar to like mileage, if you're using your personal vehicles and medical miles and that kind of thing, they ask you commuting miles and all of those things. you have to separate them out to report the right amount. Okay.
Exactly right.
Understood.
Yeah.
Okay.
So you have to kind of tease out the percentage of which is for personal, which is for business.
Right.
Okay?
Understood.
Yeah.
Okay. The vehicle.
Yeah.
Does it have to be made in the United States?
Yes, it does. So the vehicle must be made here in the United States. And usually you can find that out by running on the VIN number, also on the vehicle itself. There are on the door jamb, there's a placard that's stamped where it was actually made. And you do have to upload proof of this. You also have to upload the loan documents and so forth. So there's a lot of supporting information that you must provide in order to qualify for this deduction.
Makes sense.
Yeah.
Okay.
Yeah. The only other thing that I just want to make sure that I also point out is that this deduction, again, just like the other ones, is available for taxpayers who itemize and or use a standard deduction. So you can use it on both. And thank you.
Perfect. Thank you. Thank you for that. And thank you both for explaining these new tax deductions to our listeners. I think you made them a lot clearer than they were before we started talking. So, all right, let's move on to our next topic. I think we should talk a little bit about the overall tax impact this bill will have on the district. So, as the nation's capital, D.C. is particularly sensitive to changes in federal policy, and the OBBBA's key provisions, including tax code changes like the few we've just discussed today, for example, create both connection and divergence between federal and local tax rules. Nina touched on that a little bit earlier. But Paul, I'm going to throw this over to you. Can you explain coupling and decoupling and why this is important?
Sure. So Nina did mention those two words, coupling and decoupling, when she was speaking earlier. So basically what that means is you have the federal tax scheme, right, or the federal tax laws. And then each local jurisdiction, they also have their own set of tax laws. So IRS has theirs, DC has theirs, Maryland has theirs, and so forth, right? And they're separate from each other.
Sure.
Now, the local jurisdictions have the ability, if you will, to choose if they couple with what the federal government does. So for example, let's take the no tax on tips. So DC can say, yes, we are going to couple with the federal law and we're going to do what the federal law says. Or DC has the option to decouple, meaning that they're not going to follow that. So in other words, tips in the district, if the district decides to decouple from that, tips in the district would be taxable.
Right.
Now, why is this so important? And the reason why this is so important is because if DC chooses, and there's been no direction yet from City Council as to how they're going to go with this, but if DC does, let's say, for example, we'll go back to the no tax on tips. If they decide to decouple no tax on tips, that means your returns are going to be even a little bit more complicated to prepare.
Yeah.
And I say that just because on the federal side, you're going to remove those tips from your income. But then on the local side, you're going to have to put those tips back into your income to be properly taxed.
Right.
So the decoupling and coupling is something to follow because it definitely can have an impact on taxpayers in the district and or other areas within the DMV.
And if I can add something just from the issue of the tips about that, on the federal level, there's a provision where, for example, restaurants can pay tipped workers at a very, not below the minimum wage. And then the tips make up the difference. And the federal minimum wage rate for tipped workers is something like $2 and something to make up to the federal minimum wage. And then tips are above that. But many states, including DC, have a higher minimum wage than the federal government. So if you adopt if the state couples with the federal, some part of the tips that you're claiming, even if the state says, yeah, we're going to allow a deduction for tips, the calculation is going to be different. That there will be more tips claimed on the federal return than what is considered tips under state law because the state has a higher minimum wage. And so, everything that Paul just said about you're going to have to add something back in where it's really where the minimum wage is decoupled from the federal government, then the no tax on tip coupling even becomes complicated.
Right.
Yes. Oh, my goodness. Thank you for that example. And thank you for that explanation, Paul. I think this information, while complicated, does help us better understand the district's, responsibility with regard to the bill moving forward. So let's shift gears a little bit and discuss the importance of using a legitimate tax preparer. We've discussed this topic on another episode, and since we're talking about the ability to interpret these new tax changes, we definitely want to reiterate how important it is for taxpayers to ensure that they use an appropriate resource for preparing their taxes, someone capable of properly interpreting the tax code changes and how they apply to their individual tax situations. So let's start by explaining to our listeners what we mean by legitimate. Paul, maybe you can describe the main characteristics of a legitimate preparer and how to identify a potentially qualified preparer. And then maybe, Nina, you can identify some red flags we should look for when we're choosing a preparer.
Sure, absolutely. So as we mentioned, this upcoming tax season may be more complicated than in past seasons, just depending upon what local jurisdictions do with the coupling and decoupling.
Right.
So you really want to make sure that you have a preparer that is up to speed and has a full understanding of how to prepare these returns, because they are going to be different than in years past.
Yeah.
Absolutely, 100% will. So one of the ways that I guess I would suggest to ensure, well, not to ensure, but to help make sure that you are picking a return preparer that has the educational components needed to properly to prepare that return is just to look at a few databases that are available to all taxpayers. So the first one is what's called the IRS Directory of Federal Tax Return Preparers. Anytime a tax preparer who charges a fee to prepare a return must register with the IRS and receive what's called a PTIN. Okay. And it's a number that's unique to them. And so that's one way of doing that, to make sure that they've actually registered with the IRS, that they received the PTIN, and so forth. So that's one level, if you will, of is this potentially a legitimate and or qualified preparer.
Okay.
The way just, if you're choosing a DC-based preparer, is just to make sure that that preparer is actually licensed to operate a business in the district.
Sure.
So you really want to try to stay away from those preparers who just randomly, if you will, put out a shingle to prepare returns.
Right.
Generally speaking, those preparers are not necessarily as up to speed as other preparers that actually get a license to operate in the District of Columbia. And that's actually very easy to do. You can just go to the DC Department of Licensing and Consumer Protection, or DLCP, and you can run a check on that person's name and or their business name to see, are they actually licensed to operate a business here in the District of Columbia.
Got it.
The other way is there is a program through the IRS called enrolled agents. And so someone, for example, who's not an accountant, who's not an attorney or something like that, they can actually take a test. It's a 3-part test through the IRS where they can become what's called an enrolled agent. In other words, the IRS has deemed this person to be qualified to be able to prepare returns, and in some cases actually even represent taxpayers in the United States Tax Court.
Okay.
And so again, you can go with the IRS and you can look online to see if that tax preparer is an enrolled agent. Or if they're an attorney, you can also check with the DC Bar and just make sure that that person, if they're holding themselves out as an attorney or as a tax attorney, you can do a search with the DC Bar just to make sure that that person is in good standing and have not any issues with folks before in the past.
Got it. Okay. And Nina, do you have a few red flags that we should look for?
Well, I think, first of all, that, if somebody's saying that they can get you bigger refunds than their competitor, that's a red flag right there, because the law is the law, and it's not really up to, some fancy skills that a preparer would have that would get you more refund. It's a calculation. I think every taxpayer needs to ask, are you going to be around after April 15th? If my return gets flagged, am I going to be able to find you?
Right.
And by law, preparers have to give you a copy of the return that they filed, that you signed, or that they prepared for you for a fee. And that return has to have their name, if they have a firm, their firm, and most importantly, that PTIN number that Paul referred to, because that's your way of showing what you thought was filed with the IRS. Because sometimes what you see is that after the taxpayer has approved the return and everything's electronically filed, mostly these days, the preparer goes in and changes the numbers on the return and to create a larger refund, and pockets the difference between what you're expecting to get and And then the IRS comes back against you and says, well, this was wrong, and now we're collecting against you.
Right.
So that return really protects you, that copy of return really protects you to show that the preparer, this was what the preparer told you that you were supposed to, that they were filing, not what they actually ultimately filed with the IRS.
Got it. Okay. Let's quickly delve just a little bit deeper into this subject. And Paul, maybe talk about any scams that we should be on the lookout for.
Sure, of course. Jennifer, unfortunately, in the tax world, there's a lot of fraudsters and a lot of scammers out there that really prey on individuals. And one of the things that, in particular, I think this year for seniors with the senior deduction is that seniors really need to make sure that they're being really making sure that they're communicating with people who are on the up and up.
Sure.
And what I mean by that is, some of the things that we're seeing and have seen is that seniors in particular will receive, like, for example, an email, or they'll receive a text message that says, click here to see if you qualify.
Right.
In this coming year, we click here to see if you qualify for the senior deduction. And what they'll ask is all of your demographic information, your name, address, social security number, date of birth, and so forth. And they're not legitimate because the IRS will not reach out to you and the IRS will not reach out to you and to see if you qualify for a deduction. Generally speaking, qualified, legitimate tax preparers are not going to reach out to you to see if you qualify for a deduction. So what happens is when the senior gives them all of this information, they're now ripe for identity theft because they have everything.
Right.
So I just really want to caution, in particular, senior taxpayers this coming year, that if you get something like that, just don't respond to it. That's the best thing to do. All right.
That makes sense. Thank you so much for that. That's really important information to have. Now, before we wrap up, Nina, I understand that the OTR and the Center for Taxpayer Rights has undertaken a joint project. Can you share with our listeners the purpose of this venture?
Yeah, well, last filing season, we were really thrilled to partner with OTR and Paul's office to do an education campaign about selecting a return preparer. And so there were two things that we one major thing that we did, which was we identified those zip codes using district and IRS data where there was a large percentage of prepared 1040 prepared 1040s filed that were below a certain income level. The income level for a lot of these refundable credits, like the earned income credit. And we looked at where they were concentrated, and we picked about 5 zip codes where there were metro stations. And we purchased posters in the metro stations that were very direct and very simple and just said it was our Be Smart campaign, at tax time. Pay attention. One of the messages was, get a copy of your return and make sure the preparer signs that return. Protect your identity. Be careful about this. Warning taxpayers that they're responsible for what's on the return. So make sure that your preparer is doing a good job and not making things up because you're ultimately on the hook.
Yeah.
And we had a QR code that directed people to the web page that Paul's office had created, just talking about how to select a preparer, how to check for them, the things that Paul just went through, and some tips about, what to look for in a good preparer. This year, we're looking at bus shelters, and we're also wanting to do some direct mail in those zip codes, and also in the metro stations doing some pop-up messages so that people, as they're standing waiting for the metro, can read more information about how to select a return preparer.
That's fantastic. I think that information is really going to be helpful to district residents, and we really appreciate the collaboration between your office and OTR. So Paul and Nina, thank you both so much for sharing this valuable information with our listeners. And with that, we'll conclude today's episode. We want to extend a heartfelt thank you to our wonderful guests, Paul Smith and Nina Olson, for sharing important tips from the taxpayer advocate perspective and for breaking down the impacts of recent legislative changes on your taxes. Paul and Nina, once again, it has been a pleasure having you both on the show, and we truly appreciate your time and expertise. To our listeners, we hope you enjoyed the conversations as much as we did, and that these tax tips will be of value to you. Remember, visit mytax.dc.gov for more information and to manage your taxes with ease. We're looking forward to bringing you another great episode, and we hope you'll join us next time. Until then, I'm Jennifer Valentine, and thanks for listening to Tax Talk DC.
Thanks for tuning in to Tax Talk DC with your host, Jennifer Valentine. For more information and resources, visit mytax.dc.gov.